Hello, clients and friends of MBP Sterling Partners. It's Jamie, and I'm back with another market update and recap for you as we head into May 2026. What are we going to look at today? Well, we're going to see what's happened so far in the year. We're going to review our scorecard from the beginning of the year to see how our predictions are making out. So far, the themes for 2026 have been great earnings, great returns, policy volatility out of the political ends of the spectrum. We've seen in spades. Credit concerns have come. They seem to have passed for now, but we still think that there's some validity to those arguments. US dollar has been in decline. Gee, I wonder why. And economic and earnings resilience has been first and foremost for this market. Let's have a quick recap of where we are this year. The first quarter was actually looking pretty dicey. We saw some up months, some down months in Q1, and it ended with a negative March to bring a few of the indexes around the world into the red territory. But April came roaring back, and now we've got strong returns across the board and across the world. In the bond market, not so much. We're seeing more or less flat markets in bonds. The coupons of bonds are just slightly outweighing the negative price as yields have risen over the course of the year so far. You'll note a big divergence in the sectors within the stock market. I highlight the TSX here, where you see big returns in energy and utilities, and some weakness in healthcare and technology so far year to date. And as I mentioned, bond yields, as you can see here, on the rise. Those are 2, 5, and 10-year lines contrasted against the blue overnight rate. And you can see that the market's just not buying that central banks are going to be cutting rates. It is sending the 2s, 5s, and less so the 10-year yields higher so far this year. One of the themes that we often come back to is how concentrated the S&P 500 is of those big mega cap names at the top. Well, that came roaring back in April. There was a lot of divergence. You can see in that gray line at the bottom up until April started, and then big returns out of the magnificent, however number we're calling them right now, out of most of them, although there was some divergence across those names. But you can see big returns in April for some mega cap names, adding literally hundreds of billions, if not trillions, in market value across these names. Why is all this happening? Well, earnings. Earnings. They have been absolutely fantastic. This chart does show a earnings growth over the S&P 500, and the green line you can see here is that the earnings growth rate is accelerating. So analysts believe that earnings are going to grow at a faster rate moving forward than they have in the past. You can see these don't turn negative too often, but right now that line is curling upwards. Note that the two top lines, the S&P 500 and the earnings from the S&P, are on a log scale, so these percentages are true to form and aren't swayed by more recent bigger numbers. So you can see that earnings are picking up over this time, and we're seeing stock market activity that is commensurate with these earnings that are being released. And a reminder here from our friends at the Compound that prices of stocks and earnings are really tied at the hip. There's a very short-term phenomenon around sentiment that moves stocks up and down. We'd measure that in weeks or months, but over a longer-term period, certainly over years, stocks are very tied to how much money they are making. So you can see the returns of the S&P 500 closely track the 12-month forward earnings growth of their shares. So in our outlook, what do we see from here going forward? Well, policy volatility, that's going to continue. It's a midterm US election year. This is only going to get louder. And in Canada, we are seeing similar activities. There's been a lot of floor crossings in Canada, a lot of political activity. It just pales in comparison to what's happening south of the border. Trade disruption, that's the polite way of saying the war is ongoing. The Straits of Hormuz at this point are still blocked, although we seem to get a different report every morning about the status of that blockade, and is creating major energy constraints that the market had been shrugging off, but energy prices have been rising yet again. And you're seeing that right down to the price per liter at the pumps that I'm sure you're passing every day on your ways to work. A new Fed governor is on the way. It promised to be a little bit more contentious than it's turning out to be. Kevin Warsh has been named as the new governor. Chairman Powell will stay on, but previously assumed to be a rate cutting phenomenon. We're not so sure that's going to be the case anymore. So some of the investment themes that we should consider. AI continues. We've now moved into a different kind of AI adoption and companies that are going to benefit from AI from the cost point of view. And we're also talking about whether there's employment at risk. So more of a systemic risk to the economy if a lot of people end up getting laid off because of AI. Commodities have taken a breather in the last month, but they certainly have been in focus, not just energy from the war, but we've seen gold and metals rally quite a lot over the past year, even though they've taken a pause recently. And then, of course, nation building and infrastructure and manufacturing spending. That's coming from onshoring of manufacturing when trade patterns get disrupted, and also budgets that are leaning more towards the building of infrastructure. And you hear that a lot in Canada with the budget spending a lot on investing as opposed to spending. Well, what's going to happen in this midterm election? Polymarket is now calling for a slight chance of the Democrats taking both the Senate and the House. You can see the Senate here is more or less split, but they have more or less a lock on the House. That's Polymarket odds as of May 5th. So those obviously can change over time. And here in Canada, we're interested in seeing that the odds of Katy Perry and Justin Trudeau getting engaged by the end of the 26 are positive. They are greater than those not. Well, what about Canadian trade? We can see Canadian trade continues to get better, but just not with the US. So this chart at the top shows blue lines is Canada's imports and exports with the world, and the orange lines show Canada's imports and exports with just the US. So you can see here, you can tell exactly when the tariffs were brought in on this chart, and our balance of trade with the US in the gray line at the bottom declining significantly, but the trade is being made up elsewhere. You can see at the top, we have started to recover those exports and imports. Interesting to see that light orange line. Canada is now importing just as much from the US as they did pre-tariff announcements. How that relates to the dollar? Well, it's really been a US dollar story for the past year. We talk a lot about the Canadian dollar and whether it's up or down, but really we're talking about it in relation to the US dollar, and that's been where the activity has been, or frankly, the lack of activity. You can see here at the bottom, the trade weighted dollar. It's been range bound since tariff day, even though it declined going into it. And so for the time being, we're watching that US dollar very closely as their rate announcements come forth. As Kevin Warsh takes over the Fed, we'll get more of a direction of where US interest rates are going, and that'll give us more direction on the US dollar. So for Canadian and US rate expectations, you can see previous expectations of cuts have been priced right out of the market. So Canada had already cut, so preemptively cutting rates through 2025. We actually didn't see many more cuts being priced in, but now for the end of the year, the market's implying odds of rate hikes both in Canada and the US. And you can see here the US has erased their probability of cuts, and now it's more or less neutral. Why is this? Well, CPI is proving to be sticky. We're in that new world of CPI where we expect it to bounce between 2 and 4 and not the comfortable 0 to 2 that we've been seeing for many, many years previous. And you can see here at the bottom that the yield of longer bonds has been very highly correlated to the price of oil lately. And of course, that's been very volatile with the Straits of Hormuz being blockaded. Now, just remember, market implied rates change just as much as other prices in the market. They are more an indication of current sentiment on rates and viewpoints as they are of where future rates are going to end up. Well, what about the energy outlook? We can see a huge divergence here. The price of gas and oil have gone in separate directions. Of course, this is natural gas measured in North America, very little disruption over on our side of the pond, whereas oil is very much a global market. And you can see the price has spiked accordingly. Now, the good news is that, as you can see on the right here, oil as a input to the economies around the world is as low as it's ever been. So the impact of higher oil prices means less to the economy than it has in the past. Not that that isn't important. We all are filling up our cars, and that's an important factor for household spending. But you can see here that as an overall, in aggregate economies, oil is less important than it has been in the past. As for natural gas, where you've got very local markets, this bottom chart, you can see the difference between natural gas in Europe versus the US. In the US, very benign prices as drillers come and drill for more oil. In the US and in Canada. The byproduct of that is they produce more gas, and that's supplied more gas onto the market. So you can actually see gas prices are very low here, even though they are disrupted and higher in Europe. So from our previous outlook, you'll recall this slide from our last set of videos and slides that we were looking at what we expected to see in 2026. So we're just going to do an update on those previous slides as opposed to making up brand new ones. We will give ourselves a scorecard. So where do we stand for our optimistic takes? One was the broadening bull market and AI adopters. That's been largely correct. AI benefits are being priced into the markets, and companies are seeing cost benefits from them. Cost benefits also often means employment, so you'll hear that spun as a negative, but for the time being, these are improvements to corporate profitability. That's with the exception of software technology, where the market sees a higher probability of disruption to their revenue streams as AI comes in and takes over some of their products. Neutral and easing monetary policy, that's clearly been wrong. That's just straight up turned around now. We spoke about that on a previous slide. Canadian equity valuation advantage, that still largely exists. The discount isn't as significant as it was at the start of the year. Of course, Canada has done reasonably well this year in terms of prices. So has the US, but the US earnings have increased by more than Canadian as well. So we are seeing a discount in Canada. It has shrunk slightly, but it's still apparent. And that is also true of overseas to European and international markets. Pro-growth policy and deregulation. Well, so far we've seen that as incorrect. We're looking at that mostly through IPOs and IPO pricings. US deregulation and tax cuts. We haven't really heard anything new on that front, so we won't say that it's been positive so far, but certainly there's been a tailwind from previous deregulation as the Trump administration has taken hold. On the IPOs specifically, IPO activity is actually down this year, and we were expecting it to start to pick up. However, there's lots of talk of mega IPOs in the pipeline. So we've heard about SpaceX, Anthropic, OpenAI, all IPO possibilities for this year. SpaceX being the closest, having already filed paperwork for that. We're watching IPOs in particular because most cycles do end with an IPO boom, or at least have an IPO boom before they end. We would hardly call 2025 as an IPO boom. So we are still positive that as IPOs come to the market, that's a sign of a healthy market, even though it may be late stage. And of course, robust profit growth, that has been correct so far. We spoke about that already, and it's continuing. What were we pessimistic about in the year? Well, lofty earnings targets. Well, we were pessimistic about it, but it turns out that those targets were right, and the reported earnings have met, and not just met, but exceeded expectations for those lofty earnings targets. Midterm election year volatility, that's been good so far, but it's been upside volatility. So we've been right to be cautious about it, maybe not so much pessimistic. March was a tough month, but followed by April, which rallied right back. We just don't expect this to be over. The midterms aren't for another few months. So we expect to hear lots of activity in the markets as it results to the election cycle. Sticky inflation and higher for longer. That's been correct. We did talk about Fed independence. I'd say that's largely been put to bed. So the uncertainty around who would lead the Fed and whether it's independent, that uncertainty has eased recently, and that's certainly a positive for the markets. A Fed that is tied to the central bank that is tied to the government is never a good thing. Market participants do want to see that independence, and I'd say that has gotten better over the course of the year. In Canadian bank, credit pressures and trade frictions, those largely haven't come to pass. So even though we do believe there's more household credit pressure than there has been in the past, the market may have just overestimated it, and they're pulling the price of the banks back now, and back meaning higher, as those credit fears have not come into the earnings pictures, perhaps yet, but it has clearly been wrong so far if judging the bank's price performance is how we're judging it. And finally, fiscal deficits and rising debt costs. That's been wrong. Not that the governments have gotten any better at spending. In fact, Canada's budget is set to increase by less than people were expecting. So it's come across as a good news story, but we are seeing increasing budget deficits. It's more that the markets just haven't cared. There haven't been many fiscal hawks in the media lately. Perhaps there's just more to focus on, and it hasn't been a topic in the markets of any source of crowding out or any other kind of negative market implications. Well, you'll recall last month we did talk about the contrast between late stage cycle in terms of the equity up and down market cycle and the robust earnings that we're getting. So, what are we going to focus on today for our outlook? Well, the midterm election year. We've talked about it a lot. And so, going back and looking at the average returns over midterm years, you can clearly see that midterm years have a lower average increase in price than the other 4 years of the election cycle, and not just slightly lower, considerably lower. So the average midterm year has had a price increase of 3.3%. This is based on S&P 500 data, obviously, because we're talking about US midterm elections. But note that the number of years, the percent of years that are positive is still about 50%. So should we write off this year just because it's a midterm year? I think that's a little bit premature. So this data suggests that while we should expect volatility, writing off the year is statistically a bad idea. So what you see on the right here is the last trailing 12 months of S&P 500 returns, and the purple bars show the average returns over the last 50 years of S&P monthly returns, and the dots show what the last 12 months have been. So you can see clearly here we've had more volatile returns over the last 12 months, save November, December, and January, which are tight to those bars there. The others have been more volatile. And that's the type of volatility that we've been discussing over and over, and we are set to expect going forward as this midterm year progresses. That's about all we have for today, folks. So appreciate you tuning in. And as always, please feel free to contact us if you'd like to talk about the markets or your portfolios. Take care, and we'll talk to you next time.